So with crypto ETCs, you're now allowing that easier, that more liquid, more transparent route in for investment in the commodity or the asset class itself, i.e. Bitcoin or the other coins out there. So it's a much simpler, transparent way, and they can sit alongside then what everything else that investors are investing on their platforms.
Hello, you're watching Proactive. I'm joined by HANetf Head of Research, Tom Bailey. Tom, the FCA is reversing its 2021 ban on crypto ETCs for retail investors. What does this change mean for how UK investors can now access cryptocurrency, and why is that significant?
Yeah, I mean, this is a major shift. So since 2021, UK retail investors haven't been able to buy crypto ETCs, so they haven't been able to buy crypto through their usual investment platforms. Unlike their counterparts in Europe and since 2024, like in the US. So a lot of investors, if they've wanted exposure to that asset class, they've had to go and use dedicated crypto exchanges, which can often sit outside the regulated financial system. So lifting the ban means investors are once again able to buy and hold crypto through the kind of regulated brokers in regulated products listed on regulated exchanges like the London Stock Exchange. So brings UK in line with other jurisdictions and integrates crypto exposure back into the more mainstream investment landscape.
Crypto is often seen as a risky asset. How does offering exposure through regulated ETCs change the risk profile for retail investors?
Sure. So we have to understand, different types of risk, right? So, when you think about cryptocurrencies, Bitcoin, etc., first of all, you're thinking about price risk, right? These are very volatile assets. We've seen massive run-ups, we've seen big drawdowns. That isn't going away. In fact, that volatility is often, part of the actual appeal of the asset class. So it doesn't change at all that kind of price risk aspect. That's what investors have to consider and decide if they can stomach that potential price risk, if they think it's worth it or something they want to have exposure to. But the other kind of less considered risk, particularly around crypto, is custody risk. So when investors buy directly through, say, one of these potentially unregulated exchanges, they're taking on all sorts of counterparty, risks, that sit outside that regulated framework. You've seen for some of these platforms, different hacks and coins being lost, or people using private keys. They themselves can lose it. Obviously, we all know that famous case of the guy many years ago who threw away his laptop with his Bitcoin keys on and has been scouting around rubbish dumps in Wales for the last few years, trying to find his old laptop. You know, Crypto ETCs, like all ETCs, take kind of that risk or reduce that risk, right? It's being custodied, institutional grade, the cryptocurrency itself. They're regulated products. There's quite stringent requirements on providers of them to make sure, they do hold the Bitcoin, and then they have obviously insurance against them as well. So investors can now then gain that cryptocurrency exposure through the sort of regulated product on, as I said, a regulated exchange, like the Stock Exchange, and then buy them on an investment platform. Their Hargreaves Lansdown or the Interactive Investor if they end up providing them. And so it's a much a diminished risk of that sense in terms of that custody.
Tom, are there useful parallels between the rise of crypto ETCs today and the earlier growth of gold ETCs back in the 2000s?
Yeah, I mean the parallels are quite striking. So it's around 20 years ago, gold ETCs first basically were created, and this opened up a new way for investors to access gold. So instead of having to buy and store physical gold bars, or maybe using something like gold miners as a proxy for gold, ETCs for gold 20 years ago meant investors could buy gold on a regulated exchange in this regulated exchange traded wrapper, and essentially made gold much more accessible and liquid. A lot of investors just didn't have gold exposure in their portfolios before the advent of gold ETCs. They might have had the gold miners, but that kind of opened up other aspects in terms of you have the risk around the stocks themselves rather than just the price of the commodity. So we can see a similar parallel now with these crypto ETCs. So before crypto ETCs in the UK and Europe, or crypto ETFs in the US. We've seen a lot of investors have been kind of historically gaining exposure in that proxy way. They might be buying, a basket of stocks which are involved in the cryptocurrency ecosystem. Crypto miners, or some of the exchanges that have listed on say New York Stock Exchange, etc. So with crypto ETCs, you're now allowing that easier, that they're more liquid, more transparent, route in for investment in the commodity or the asset class itself, i.e. Bitcoin or the other coins out there. So it's a much simpler, transparent way, and they can sit alongside then everything else that investors are investing on their platforms.
Tom, thanks as always for your insights. Good speaking with you.
Thank you.
Tom Bailey, Head of Research at HANetf.